Good afternoon, Quasar Markets Live. We all got him. It's Kevin Green. He is suited up and booted up. He's ready to go, man. How are you, Kevin?
Doing pretty good, Steven. How about yourself?
I love it. I just had a chance to test it. I'm just talking before the show that I was just in New York. I was in Charleston, South Carolina. I was in Washington, D.C. Three similar places, three similar themes. Not quite the same type of people, a little different, right? But they were all talking about one thing, and that's AI, quantum computing, tech, as I always say, on even the Schwab Network, as I was talking about it this last week. But everybody has the same malaise feeling. No one's going, ooh, the world is great right now. We've got just way too many problems. We've got obviously with China and Ukraine and Russia. We've got budget talks of a government shutdown. We've got job losses. I can keep on going, yet the market makes another new high back to on NVIDIA. What is going on? Break it down for us, Kevin. I have no idea what the hell is going on right now.
Well, look, the world is always burning. That's one thing that we always have to keep in mind. There's always going to be a problem somewhere. And I think the market right now understands the fact that we have this secular trend with artificial intelligence. We have also some other, thematic type of trends taking place when it comes to power generation, maybe when you're looking at the quantum computing space as well. And if you're getting these dollars from these mega cap names and these big players and this whole arching theme about building out artificial intelligence and integrating that into each and every aspect of our lives here, there is going to be a demand story for that. And that demand story is also going to be coincided with dollars being spent by a lot of these companies. And those dollars being spent is also obviously going to reflect within GDP. And I think that's what you are seeing as far as the optimism here for the market. If we take AI out of it, we take the data center spend out of it, which is about 0.7% of GDP right now, it doesn't look too rosy. If you look at the consumer spending data in some pockets, we do have some strength, but we do know that a lot of consumers are over leveraging right now in the debt space. And we do have some uncertainty when it comes to the treasury market as well as the geopolitical risk that is out there. But until you actually see something fundamentally crack, and I always look at the credit space, until you actually see some form of a credit exposure type of risk event taking place here, it's really hard to knock the market down for a substantial amount of time. And this buy the dip mentality continues to stay in place. If you're looking at credit spreads right now, they look actually fairly healthy for the most part here, outside of credit within the student loan type of space. Some areas of commercial lending still a little bit of a problem here, but overall the market is healthy. We have liquidity. And until we actually see something kind of change here when it comes to the dynamics of the economy, I think the market's going to continue to try to bid up even higher, even given the risk that we do have on the geopolitical front. And a lot of the geopolitical risk events that you have, Stephen, over time, if you kind of look at them, they have been buying opportunities for equity holders for over the long-term buyers of equities, maybe not the intraday swingers.
Yeah, I mean, you're right. In a lot of ways, I think people just, buy the dip mentality has been working. I guess it's COVID pretty much, right? But what do you say to people like, hey, you know what? The market's kind of high right now. It's kind of frothy. It feels like there's a lot of malaise in the markets. We're not, and of course, volatility just isn't there. The VIX is not going nuts. It's under 16 again. And all of these geopolitics in the past, Kevin, while it may not seem like it, but then all of a sudden some black swan event. Oh, well, we didn't see it. This is different this time, blah, blah, blah. I've heard it all. I've heard it since 1987. So, I think I said this on the Schwab Network the other day with Nicole. I said, it feels like the Price is Right guy going up the side of the mountain. He just keeps going up and no one knows when to take the mountaineer off the mountain, right? Is there something that you can see in the markets that, or we don't see yet, that maybe insiders do see that might change the philosophy of the retail? Is there something out there that's going to change their thoughts?
That's actually a really good question. And right now, there's several different things that I look at in the market, and obviously everybody has their own little gauges. So let's go through a couple of the things that I look for. First is obviously, once again, credit spreads, looking at liquidity for high yield credit. I think that's going to be your first signal if you're going to get one. Basically, credit spreads blowing out or expanding, which obviously would lead those credit spreads to move a little bit higher there. That actually then leads to lack of liquidity within the market. You don't have buyers really kind of stepping in, or you have too many buyers getting into those credit default swaps in order to protect their risk. We don't see that right now. And actually, credit default swaps themselves, the pricing actually is a decent leading indicator for equity volatility. If you actually overlay the two on a chart, let's say you're looking at North American high yield credit spreads and compare that to the VIX just itself, there's actually a pretty decent leading indicator for credit spread. So that's one thing that I kind of look at. I also look at market depth for the E-mini S&P futures as a liquidity gauge. There's other gauges that are out there, but how many people are on the bid? How many people are on the ask? You're basically looking at the bid-ask size that is out there, because that the more size you have, the more liquidity and more trade you can kind of soak up. Is that really draining out right now? It's not. And seasonally, this is when we actually do see that kind of draining out. So I don't see that as an immediate, factor that's being priced into the market. M2 money supply, meaning moving to the upside here. You have spending from the large, mega cap names, we'll call it the Big 10, right? If they're going to continue to spend, where is that liquidity going? I get what you're saying. I've been saying it for the last year and a half. I'm right there with you, but it's also hard to fade that type of market as well. You could go back in and say, could you buy vol? Can you buy long duration vol at this point in time if you were concerned? And the reason why you asked that question, it's not a recommendation, but could you buy long duration vol to wait for the event that could hit the horizon? Because there's a lot of risk out there. You want me to talk about the risk? You got buy now, pay later risk. Guys, I'm just going to make a joke here. I'm going to make a real quick joke here. It's not even a joke. This is actually, I screenshot this. Facebook, they get you like these weird
You can
ads.
share your screen if you need to. If you want to share your screen, you can. You got something out there, you can.
Oh, I'm not going to share because this is going to be borderline. I might get in trouble, but I'm going to.
You won't get in trouble here, bro. Okay.
So, on Instagram or Facebook, you get these ads, these weird ads or whatever. And then I was scrolling on Facebook today, and there was this weed stocks are kind of like in the vogue today because of something that President Trump posted the other day. So I was like, oh, that's really odd. I did not know that in Colorado you could buy cannabis, like have it shipped to your house. I don't know why I thought that. Well, whatever. There was an ad for it. I was like, clicked on it, and you click on this ad. And the reason why I bring this up, Steven, buy now, pay later to buy weed is absolutely crazy. Like that's peak lending moment, in my opinion. If I could ever see any more peak moment, is buying marijuana on buy now, pay later. That is a risk. Student loan risk is still out there, right? You still have 33%.
I mean, if they're not paying for the cannabis, they're sure as hell not paying for their college.
Right. So there's risk that's out there, but nothing has been.
But explain to me, okay, and you hit the nail on the head a second ago. 2 weeks ago, there was 7.2 trillion on the sideline in money markets. Well, they're now 7.6 trillion now in money markets. Now it's crazy. It's a crazy amount of money on the sidelines, and yet the markets are going up and up and up. And I get the buy, I get the bid and the ask, I get all of that. Where is this money coming from? Is this international money? Is this money from institutions? I can't imagine institutions are buying up here.
Yeah, no, it's institutional money. So that metric or barometer of money market funds of 7.3 trillion or 7 trillion or 6 trillion, you notice that number continues to go up, and it's going to continue to go up right now. There's two reasons why. It's commercial money.
Yeah.
Those commercial dollars are cash that's sitting on the sidelines for, let's say, a Microsoft, or let's say it's a mid-sized company, landscaping company, whatever. Usually they want to use that capital in order to expand their business. But nobody wants to really kind of expand. Nobody wants to spend a lot of capital outside of the artificial intelligence space. You're not seeing a company going out and say, "Hey, we need to expand our footprint in the commercial real estate."
What about M&A? We just saw EA
that could be something.
That's what you're saying.
That could be something as well. But money market funds, you're probably going to see more dollars getting into that bucket as rates go lower on the cash front. Lower duration or shorter duration assets, there's nowhere they got to deploy that capital. Basically, and I forgot who actually did this study on this, but there's actually a study. It's perceived that around 60% of those funds in the money market, that pool is actually meant for large commercial institutions that are looking to have those funds utilized for capital investment. They kept it in those money markets because they were paying a pretty decent rate, and they didn't want to spend the money on expansion.
And now those rates are coming down. So yeah.
Right. So they're going to have to deploy capital because at some point in time, the rates are not going to be attractive enough. They're going to have to they're going to have to deploy it somehow, some way. And now the thing is that people think deploy capital means go into equities. or go into treasuries
Right.
or go in. That's not really the case. It means, okay, we've been waiting on this project to build something, XYZ.
Right.
Rates are lower now, market's slowing down a bit, prices are coming down. That's the thought. Now we can actually go and spend this money in this community and build out this new healthcare facility. That's the money out of those money markets.
And what are they
That's
waiting
going to
on?
be.
What are they waiting on, Kevin? I mean, are they just waiting on lower rates that think Trump's going to pull up, going to continue to stack the deck over the Fed? I mean, it's just not happening right now. I mean, you saw Powell talk about it. He's like, look, maybe one and done kind of thing here, a risk management cut. I still don't even know what that means. I mean, I'm trying to figure that out. I think it's a made up statement there. What are they waiting on, Kevin? Are they waiting on lower rates? Are they waiting on what?
Well, lower rates are going to force them to deploy capital elsewhere because they're not making much more money on those rates. So let's go through a couple of examples just so people can kind of understand. If you're a healthcare company right now, Stephen, are you really trying to put dollars to work and expand? Let's talk about healthcare services. You have a hospital. Are you really trying to build out a hospital right now when the funding is kind of unclear when it comes to the administration? If they're going to have funding, they're pulling capital right now. So are you going to put money to work? No, I'm going to keep my money in the money market fund. If you're going to be an industrial company, let's call it a Caterpillar, are you going to expand out factory and production lines right now in this environment? Probably not.
Probably not, but they might spend that money for R&D.
Yeah, but R&D is only going to go so much. If you're talking about an industrial company,
maybe
can only go
John Deere, right? So John Deere may make a new electric tractor. Maybe they need little R&D to hire some people to do that. I can see that.
Yeah, but it's not going to be
putting a new manufacturing plant in because of the lower rates. I don't think that's happening.
And then you don't know what's going to happen with the dollar. You don't know what's going to happen with tariffs. So where are you going to put the money? Where are you going to use the money right now? You're going to put it in the money market fund that's earning 3.5%, 4%,
silver, Bitcoin.
Gold.
I mean,
these are institutions. These are large institutions. We're talking about a company. A Caterpillar is not going out and putting 20% of its capital into Bitcoin. That's
the United States government is. United States government's buying Bitcoin. The United States government's buying Intel. United States government. I mean,
different. They also hold the purse, right?
Yeah.
So, and you can go industry by industry right now, and there's enough uncertainty out there where you could say, hey, let me sit and wait. Let me see how this is going to shake out before I actually do something.
Yeah.
So there's going to be capital that's going to be deployed, but it doesn't mean it has to be in the equity market. It probably will be in the economic front once we get stability, if we get stability, and once we get stability when it comes to a lot of these policies. So I think that's where it's headed right now. I go back to the fact to say, look at the dynamics that are out there. Is there perceived risk? There's always risk. Is the risk right now reflecting itself enough where you and myself could say, hey, watch out. I don't think we're there yet, but this is going to be a market where we are cutting rates. We're trying to run the economy hot. We all know what this playbook is going to be, and it's a very hard playbook. If you think inflation is going to go up, hard assets and assets in general usually rise in that environment. Purchasing power also erodes in that environment. And the goal for you and myself and everybody else as investors is that the alpha that you have outstrips the lack of purchasing power.
Okay, you're right. Commodities go up in this kind of situation, and we have gold's at all-time highs. Silver's pushing up to $47 an ounce. Hasn't been there since the 70s. I mean, what are you going to buy more copper? Are we going to buy more gold? What are you going to do? I mean, everything is frothy right now.
Silver probably still. Silver technically probably still. And once again, not a record because the silver is going to be the first one to crash. Like when I say this, when you do see a reversal in this metals trend, silver is a higher beta name. Yes, silver is a higher beta play, and it's probably going to be the first one to give you the signal that the party's over. But technically, silver's just kind of just getting close to that cup. It's just building out the cup. Where gold blew out that cup and handle that it's been forming for years.
We're going to pass $50.
Yeah, I mean, it's possible. Yeah, you know what's crazy? I was on a podcast like 2 weeks ago. Silver was trading at $42, $41. I think it just got to $40 or something like that 2 weeks ago. And somebody was like, "Hey, is it possible that silver can go to $50 by the end of the year?" It's like, yeah, it's possible, right? I mean, this thing it's printing 3%, 3.5%, 4% weeks. I mean, the trajectory is definitely there.
I was buying
Technically,
silver.
you could-
I was buying silver at 19, right? Which is where most of my silver is located at. And a part of me wants to get rid of it. Like I'm like, okay, great. You know, I had a good run here. Part of me doesn't want to do it. Part of me is like, you know what? It's now I'm not a FOMO person. If I think the price, I think it could go to 100.
Can I ask you a question?
Yeah.
Can I ask you a question? A couple of questions here. Do you think inflation's going higher?
Absolutely.
Do you think the policies that we might be putting into place right now could actually spark hotter running economies, not only here in the United States, but let's say Asia Pacific markets?
Good question. And I see where this is going. You know, I even said on Schwab, stagflation. We're literally living in stagflation, lower job losses. You can't get a job when you lose your job, and inflation is going up. It's a terrible economy. I think that's more where my mind is than hot emerging India, BRICS, whatever. China being another hot one right now, right? If we believe their manufacturing numbers, which I don't. You know, it's a good point. It's a good point. I don't know.
Do you think the electronics? Okay, so we probably have a little bit of a refresh cycle happening with Apple. We still have the industrial boom when it comes to semiconductors.
Got the new watch, got the new phone. So yeah, I understand what you're saying.
Silver's at 90% of all electronic products in one way, shape, or form.
I think that's the difference for me, that there's gold and silver actually in these electronic products, and rare earths are tougher to get. Prices are going to go up, inflation is going to go up. So yeah, I know, I totally agree with that one. Yeah. Wow. One thing I love about Kevin, for those of you out there in Quasar Markets land, I love the conversation, right? Is the taking it to the next level, because we're both in the business so much and so long, but we know the real players. We know what's really going on. And I have to ask Kevin, you have a lot of guests on Schwab, some of the best in the planet. What is the overarching theme here between all of them? Like what they all have the extremes. I'm one of the extremes, I guess, now because of stagflation. But what is the overarching theme right now? What are they saying? If you were putting all your money into something, they're all saying one thing, but they're all saying a different.
Yeah, I think a lot of people are saying exactly what we're talking about. Yeah, they're not talking about this time next year. They're talking about the next 6 months. And the themes right now doesn't seem like they're pulling back. Everybody's into the power narrative right now as well. So keep your eye out on that space. Some of that might be a little bit misdirected. I think if you're somebody that's looking for a new theme, power is going to be that new theme. But be careful. I think people are going into this and they're just diving in and they're looking around and they're saying anything that can generate
alpha
AC current right now, we want to put down. And be careful, because utility and electric markets are very eccentric, and there's on-grid, there's off-grid solutions, there's renewable solutions, there's geothermal solutions, there's nuclear solutions. Like the nuclear theme, I love the notion, because people are saying, hey, Oklo, like this company makes no money, this company doesn't do this, that, and the other. Look, it's a proven design that submarines use and have been using for a fairly long time. They're basically just putting that on shore.
That's right.
The problem that you have is, where are the data centers going to be located for these small modular reactors? And here's the reason why. It's not the uranium. The uranium is going to be a problem. This Russia-Ukraine conflict continues to escalate. You cut off Russia from processed uranium, you're talking about Kazakhstan, Canada, and maybe a small slice of what we can do here in the United States. Russia's a huge provider of the uranium that we can actually use. So but that's not a near-term problem. That's a build out the reactors by 2027, 2028. You'll probably have uranium supplies to 2030, and then you have an issue there. But Steven, water.
Oh my God, you took the words out of my mouth. I mean, you're totally agree. Totally right.
Water is going to be the problem.
Right. Do you think hard water is an issue?
It's going to be a problem. Dude, if you think about this, just check this out. I'm in Colorado right now. There's a couple of things I want to. I don't. If I'm over time, you let me know. A couple of things.
No, I love this. Let's go. Yeah, enjoy it.
So you're hearing about all this. Oh, we're going to build data centers out in Nevada. Now, the reason why I kind of bring this up, look at the companies and look at the dynamics. Nevada really probably cannot sustain the nuclear trend as much as people probably believe, but you're seeing data centers being built out there. If you're looking at Colorado, we don't have water. Nevada does not have water. So there's a lot of places that might be a little bit constrained. And this water that you need to cool these reactors, you're still going to need it. The technology is nice, but where are you going to get it from? So I think it also kind of constrains you a little bit when it comes to the locations and the resources there. Also, who actually services that water? Who provides the nuclear products and services for that water? This is not a recommendation, but there's only a couple of companies that actually already have the products in place. So I think when you're looking at the power theme, you got to think on grid, off grid, and then what's the flavor? What's the big tech companies really doing? And Google is not going full on nuclear. Google's leveraging a lot of geothermal, and I think that's going under love. That's not a recommendation, but the geothermal is going to probably come back into the picture, I would believe here. You're going to hear about it a little bit more because we have fracking technology that basically can tap into hot rock anywhere here in the United States. And all you need is hot rock, pipes, and some water to create a closed system to generate electricity. And that actually that gives you a little bit more flexibility. People hate solar and wind right now. Wind is just not going to get any love on the regulatory front, but solar probably is still going to be a solution. Nuclear is going to be a theme as well. I got to go back though, Stephen, and say the companies are expensive. The technology is good. The trend probably will continue, but understand once they get their operations up and running, you're not going to see massive revenue generation on a year-over-year basis, sustained for 10 years, 15 years. They're still power players. Power players just don't have that much, have return on investment. So don't throw all your eggs in one basket. The power theme is still going to be diversified. I think people are underselling it. Oh, for your viewers, Google partnering with Fervo Energy. They have 2 data centers in Nevada that they are powering off of this geothermal technology. They go into the hot rock, they move over, they have these pipes, they put water into the pipes, they heat up a turbine, and they're powering 2 data centers with this. They bring up these operations in a matter of a year and a half, 2 years. So keep your eye out on that type of stuff because it's something that a lot of public companies don't have exposure to. Berkshire does have exposure to this type of technology with Berkshire Energy, very small portion of their portfolio, only like 3%. But there's more than just nuclear. And I think that's where the market might be a little bit mispriced here. Everybody was talking about natural gas and having that be the trend this time last year. And it's natural gas is going to be a solution, but it doesn't mean that you're going to see this massive rip to the upside for natural gas companies that provide for the utility sector. You're going to have a blend here. And I think the power theme right now might be a little bit concentrated in the dollars that are being put to work, but the easier solutions, solar, geothermal, and some others are probably a lot cheaper when you're looking at valuations than some of these nuclear names.
Yeah, and I think nuclear, Mike, for me, we talked about this over the weekend a lot, and I'm going to keep you, if you don't mind. I'm going to keep you for a second here.
Yeah. I'm good.
I love this. It was a very serious conversation, late night drinks. The biggest problem in energy right now, I think, is still refineries. The refineries they're aging. The second biggest problem in energy, no matter how you get it, is the lines that deliver it, right? We're still using aged lines. A lot of them aren't even put into underground. They're still above ground, and we lose half the energy before it even gets to your house. So is there going to be an infrastructure boom here in the next, because the president wants manufacturing here. I think we need to have a boom in actual production of energy transmission.
I agree with you. The one thing that's going to be different, though, and I'm not sure if you're going to get a lot of support, is that an infrastructure project like that, do we have the appetite from a government standpoint to fund that? And even though we want to think of these companies being, philanthropic, I don't think that a lot of these companies are going to build out the U.S. energy grid.
I have the answer. Just make a crypto coin. The president will be very happy about that. We'll sell those for the production of transmission lines.
Stephen, so you're talking about refiners, and I want to talk about that just real quick. So we don't build out a lot of new refineries, and it's not so much. Building up a new refinery is very expensive. Two, there's regulatory hurdles, and three, where do you put them? If you kind of notice, the landscape of the United States has changed pretty aggressively over the last couple of years, 100 years or so. Where do you put them? You can't put any refiners on the Mississippi anymore.
Well,
Because
I think you have to put the refiners where they're at now, or we clean up the ones that we have and bring them up to speed, right? And
Yeah.
modernize them, right? I mean, we have them in the Gulf for a reason, but the Gulf is where we get hit by hurricanes. We have them in Texas where they get hit. We have them, you know, and we don't need more transmission of oil lines. We have plenty of that. The Keystone Pipeline was a joke, but when I look at where we are spending money, we can build nuclear power plants right in the middle of the country, and who cares? Great, but if we can't refine any more oil, which we're on fossil fuels, we can't refine anymore. Or the problem is when we do refine something, it's what percentage do you make it of gasoline? What percent do you make it into ferro? I mean, there's all kinds of energy, right? So yeah, we have a problem.
So the refiners are not built. The refiners are not built to process the oil that we produce. So that's why we are the #1 oil exporter in the world, because you're right. Our refiners in the North, in the Midwest, are built to refine heavy sour crude, which we import, especially from Saudi Arabia, not so much light crude. Now, they can refine light crude, but then you need additional additives and chemicals in order to do so, which obviously then eats into the crack spread or that margin in order to produce. I'm right there with you.
Okay, good point, Kevin. Great.
Oh,
Explain crack spread to our people. I love this. Those of us, I love this. To explain crack spread.
Yeah, so a crack spread, and there's a bunch of different ones. If you go on the CME website, they have a couple of crack spread calculators. So what does that mean? That just means refining oil into a particular product or a group of products. So one of the popular ones is a 3-2-1 crack spread. 3 barrels of oil makes 2 barrels of gasoline, and then 1 barrel of diesel. There's all different types of mixes. You could have there's 2-2, there's 2-2-1s, there's all of these different ones. And kind of depending on your refiner, it just depends. So you can go and check those out, but it's just a measure of profitability. So if you're a trader and if you are interested, you can DM me too. I have a crack spread indicator for TOS. You're basically looking at the profitability of a refining company, right? These refiners out there. And so as the crack spreads move up, meaning your margins are higher, the profitability of you refining 3 barrels into 2 barrels of oil, gasoline, 1 barrel of oil goes up, you make more money. As those crack spreads go down, you lose more money. So the more that I have to put into a process to make, let's say, gasoline from light or something heavy, if I have to use heavy sour, which is what we are built out for the most part in the Midwest, a lot easier to refine. If I have light sweet and I'm utilizing a Midwest refinery, let's say it's the Whiting refinery in Indiana, might as well be India. You might have to put more chemicals in it in order for you to get that final product that you need to make the product a little bit more stable. So we're nerding down there, but if you kind of look at it, what was funny, I had a post about this on X earlier this year. Crack spreads were moving up. Profitability for refining companies were moving up pretty much since December of last year. And you saw these refiners moving lower. Like even after the April lows, the refiners were moving lower and the crack spreads were moving up. And there's like this huge divergence within the fundamentals and the technicals of these companies. And this is one of those situations, if you're an oil trader, you could find an opportunity or an ARB, if you will, an arbitrage opportunity. And now, if you look at those refining companies, if you look at the ETF crack, the CRAK, if you look at those, they're printing money hand over fist now, because now the price action's meeting the fundamentals of this company. So it's a big deal. But we need electric generation. People are poo-pooing on solar. But let me tell you, the additional power that's being brought on year over year, Stephen, no matter what the policy is right now, what the projection is moving forward by the EIA, 60% of new power being brought online, gigawatt power being brought and put into the grid, is still coming from solar. Right. So you can say whatever you want from the politics of it, not saying you, but you have the politics of it, but it's the quickest to market that you can bring to add on additional supply to the overall grid, hands down. So if you have an immediate need, or if these companies have immediate need for data centers, they need batteries, they need solar, they need some other projects as well, but the immediate growth right now is still solar, no matter kind of what the EI, is saying.
Growth
At least
is
ahead of the
in
EI.
solar. There it is from Kevin Green. Growth is in solar. Kevin Green, Schwab Network. We love Schwab Network, as you know. I'm
Appreciate you.
very happy to call you a friend. Kevin Green, everybody. Thanks, Kevin.
Appreciate you.